Warren Buffett has used these 7 investing criteria to become one of the richest and most successful value investors of all time. And in this video, we're going to see what companies, if any, actually meet all 7 criteria going into 2024. And that way we can get a sense of what companies on the stock market right now might be considered undervalued, that investors like Warren Buffett could be considering buying into today. Now, it's pretty easy for a company to hit 1, 2, or even 3 of these criteria, but as you'll see, to hit all 7 is actually pretty rare. Now, the last time I conducted a search to find value stocks using these 7 criteria, the top 5 companies on the list were Olympic Steel, Toll Brothers, Pult Group, KB Home, and Lennar Corp. And this was about a year ago, or let's say 9 months ago. Now, if we look at the stock prices of those 5 companies since I did that search, Olympic Steel is up 65% year to date. Toll Brothers is up 69% year to date. Pult Group is up almost 91% year to date. KB Home is up 66%, and Lennar Corp is up almost 39%. So obviously there's something to this. Now, I'm absolutely not saying that you should YOLO all your money into whichever stocks meet the criteria at any given time, but it's a good starting point to see what stocks might have significant potential upside going into 2024. All right, so let's go into my stock screener tool, which is with the TD Investing app. And this is where I'm going to be able to apply the 7 different criteria. And you'll see each time I add a criteria to the list, it's going to whittle the number of stocks that are left down to a handful. So the first criteria on the list is company size. Warren Buffett and other value investors aren't interested in penny stocks. They only want to invest in well-established large companies that have significant revenue. So we're going to set a search criteria only to include companies that have in excess of $100 million in annual revenue. So I'm going to set this first criteria as revenue TTM, which is the trailing 12 months or the last 1 year of sales or revenue. And I'm only going to look at companies that have TTM revenue that is over $100 million. And when we add that first criteria, you can see now that there's 4,884 potential companies that meet that. So let's move to number 2, which is the current ratio. Now, the current ratio is one measure of a company's financial health because it's measuring the assets versus the liabilities. And the Warren Buffett / value investor criteria is to only invest in companies that have a current ratio of at least 2 to 1, meaning that they have $2 in assets for every $1 in liability that they have. And so if we add a 2 to 1 current ratio filter, we've now whittled down the total number of potential companies to 1,452. So you can see that we're quickly chopping off thousands of companies. Okay, the third criteria is related to dividends, and more specifically, the company must have continually increased dividends over time. Now, the value investor criteria is meant to look back over a period of multiple years, even decades, but the best proxy I have in this stock screener tool is the 5-rate dividend growth rate average. And so if we include this and set it to only include companies that have increased their dividends over an average of 5 years. So if I set the filter for 0% or higher, this is going to weed out any companies that have not, on average, increased their dividend over the last 5 years. And when we set this criteria, we're already down to only 326 potential matches with still 4 to go. All right, the 4th and 5th criteria I'm actually going to lump together because they both have to do with earnings. And the 4th criteria is that there must be at least some earnings per share. And the 5th criteria is that there must be at least some earnings per share growth on average over at least the last 5 years. So this is earnings stability and earnings growth. So if we add a filter for 5-year historical earnings per share growth and only filter companies that have at least increased their earnings per share on average over the last 5 years, then that's going to satisfy both of those criteria of earnings stability and earnings growth. And when we add that, we're down to 232 potential matches. The 6th criteria is price to book ratio. And this is one of the things that is measuring whether or not the company is undervalued or overvalued. Because if it has a relatively low price to book ratio, it means that the price of the stock relative to the value of all of the assets the company holds is pretty close. But if it's a high price to book ratio, it means that the price of the stock is much, much higher than the actual amount of assets that are held on the company's books. And the value investor criteria is generally that the price to book ratio should not exceed 1.5. Because any company that has a price to book ratio of 1.5 or lower is, generally speaking, going to be considered more undervalued. And with that filter, we're down to only 47 potential matches with one final criteria to go. And the last criteria is also related to valuation, except that this time it's the price to earnings ratio. And so we are only looking for companies that have a price to earnings ratio of 15 to 1 or less, because anything in excess of a 15 to 1 PE ratio could be considered more on the overvalued side of things. And anything below that is, generally speaking, more fairly valued or potentially undervalued. All right, and so with that final filter of a PE ratio of 15 or less, we are now left with 33 matches. Of the thousands of companies listed on the stock exchanges in North America, there's only 33 that currently meet all 7 criteria. So let's take a look at some of the top ones. Now, I'm going to walk you through numbers 1 to 5, but you'll see that they're not as interesting or exciting as numbers 6 to 10. And I think that more of the actual alpha would be considered numbers 6 through 10. But let's get there in a second. Interestingly enough, the top couple of stocks are actually some of the same ones that were considered undervalued when I conducted this search at the beginning of the year. And these are home construction companies. So we got KB Home and Lennar Corp with 2 different classes of shares. Now, KB Home is a home building company based in the US that operates out of Michigan. It has huge revenues, over $6 billion. It has a solid current ratio, meaning that it has a lot of assets relative to its liabilities, and its dividend growth rate and earnings per share growth rate is quite high, as well as having some valuation metrics that are definitely considered to be on the undervalued side of things. And more or less the same situation applies to Lennar Corp, which is also a home building and construction company. And I find this interesting because even though both of these companies are up significantly over the past year, they are still considered to be undervalued, at least according to these 7 search criteria that we're using. And if we think about this logically for a second, it partially at least makes sense to me, because the real estate industry in the US and North America and around the world has definitely taken a hit, what with the rising interest rates and the increasing cost of construction over the past few years. And so even though we know that these companies have still technically done well recently, if there was to be a shift in interest rate policy with interest rates going back down, then these types of companies, home construction companies, could take off even more than they have. Okay, moving down the list to numbers 4 and 5, these are also real estate and construction companies. Surprise, surprise. So the top 5 companies on the list are all related to the real estate industry. And this makes sense because real estate and construction companies usually don't have high valuation metrics like tech companies, for example. They have solid revenues, and also they have decent current ratios. Although I'll say that Toll Brothers is at 4.5, which is pretty low, meaning that it has less assets relative to liabilities than, for example, Lennar Corp, which has a current ratio of 17. And so whether or not you would want to invest in one of the companies in the top 5 here, I guess really depends on what you think the prospects are for the future of the real estate industry, especially in the United States. All right, let's take a look at numbers 6 through 10 though, because there's some more interesting ones here that did not appear on the search that I did earlier in this year, and that are also in completely different industries. Okay, so coming in at number 6 on the list is Vici Properties. Now, this is a company that is in the real estate industry, but it's actually building and operating casinos, mainly in Las Vegas. And this company is interesting because when we look at the stock chart, it's actually down over 10% year to date. If we look at the 1-year chart, quite similar. And if we look at the 5-year chart, it has been more or less flat for a couple of years. It has not made any substantial gains. But this company still has over $3 billion in revenue. It has a crazy current ratio of 27.5 to 1, meaning they have a huge amount of assets for any amount of debt that they have. The growth in their earnings per share is exceeding 50% over the last 5 years, and its valuation metrics are pretty solid. It's got a 1.23 price to book ratio and an 11.91 price to earnings ratio. Now, this is actually the highest PE ratio of any of the stocks that meets the top 10, but it's still falling within the threshold that's set out by the value investor criteria. So I think that this one will be an interesting stock to watch over the next year, especially since it also has a decent dividend yield of 5.83%. And the casino business is a pretty good business. Okay, coming in at number 7 on the list is Shoe Carnival Incorporated, or ticker symbol SCVL. Now, this company is a family footwear company that operates in the US. I'd actually never heard of this company before today. I'm not from the US. But if we look at the stock chart year to date, you can see that it's pretty flat. It's technically up 3.57% year to date, but it has not really done much. Now, this company is smaller than some of the other ones that we've been looking at. It has a market cap that's below $1 billion. But if we go back over here and look at some of the other metrics, it's still making in revenue over $1.2 billion per year, increasing its dividends, increasing its earnings per share, and it has very reasonable valuation metrics. Although the current ratio here of 3.14 is the lowest of any of the stocks in the top 10. So meaning it has the fewest assets relative to its liabilities. Also, the dividend yield on the stock is 1.74%. So when we're considering this one, I'm not sure if I'm as high on it as some of the other ones on the list. I think Vici Properties is actually a pretty solid stock. This one I would have to do a little bit more research, a little bit more digging, but like I said at the beginning of the video, the purpose of this is not to just YOLO into any of the companies that make the list, but rather to use it as a starting off point and then to dig more into some of the companies and see whether or not they actually make for good investments. But still, this could be considered potentially an undervalued company. All right, next on the list at number 8 is Dynacor Group Incorporated. Now, Dynacor Group is a gold mining company that's headquartered in Montreal, Canada, and it looks like it's mainly engaged in gold production by purchasing ore from other miners actually, and then processing it. So rather, it's a gold processing company. The stock price year to date is up almost 13%, and despite having a pretty decent year, it's still falling within the value investor metrics that we're applying to our stock screening tool. Now, the market cap of this one is very small, just over $100 million. And if we go back over here, we can see that its revenues are definitely on the lower side at $300 million. However, its dividend increases and earnings per share increases over the last 5 years on average have been very, very solid, and the valuation metrics are very low, meaning good. There's also a dividend yield for this stock of 3.48%. Now, I would definitely have to do more research into this company to see whether or not I think it's actually a buy. It's clearly a little bit more on the penny stock side of things, but it's still a decently large company with a well-established track record. However, one thing that makes me curious about this is that the price of gold actually has not been doing anything crazy recently. And so that makes me wonder why the price of the Dynacor stock is up so much year to date and why the company is doing so well. So definitely more digging required on that one. Anyways, let's move to number 9 on the list, which is Melcor Developments. This one is also listed on the Toronto Stock Exchange. Now, Melcor is another real estate developer. If we look at the stock price, it's up almost 5% year to date. The market cap of this one is also pretty small at $350 million, but it has a decent dividend over 5.6%. This company has the smallest revenues of any of the companies that made the top 10 list, though, coming in at $266 million in revenue over the last 12 months. However, the price to book value of this company is ridiculously low at 0.29%. So what this means is that relative to the actual value of the assets held on this company's books, it is trading at a laughably low price. And this is definitely an indicator potentially of an undervalued company. So this is something that we would want to dig into a little bit more, see what those assets are, compare them to the liabilities. It looks like the company has a pretty decent current ratio with way more assets than liabilities. So the fact that the price to book ratio is below 1, it's just above 0, suggests to me that there could actually be something here. So I would want to do a little bit more digging. Now, the actual increases in dividend and earnings per share have not been stellar, but just based on the price to book value alone, that is definitely something worth at least looking into. And to round out the top 10 list, we have Commercial Metals, and this is a company listed on the New York Stock Exchange. So this is a metals company based out of Texas, but it's actually adjacent or related to the real estate industry because it looks like their main product is rebar. It is one of two primary suppliers of steel used to reinforce concrete in buildings, bridges, roads, and infrastructure in the US. Now the stock chart of this one year to date is not so good, down 6%, so that could be potentially why it's coming in on the undervalued stocks list. This one is a big company with a market cap over $5 billion. Its revenues are over $8 billion, and it's got pretty solid increases in dividend yield and earnings per share, as well as very low valuation metrics. Now, I am not going to go through each of the 33 companies that came up when we searched for these 7 criteria because it would take way too long, but I will scroll through so you can take a look just in case you're curious and you want to do some additional research for yourself. So I'll just slowly scroll through the second page of results here. You can see that not all of these are in the construction industry. While in the top 10, I think 6 or 7 of them were actually related to construction or adjacent to construction. We've definitely got some other types of companies in here, including on the resource side, it looks like. Coming in the top 30, we've got Marriott Vacations and Universal. So some entertainment and vacation companies in there as well. And these are the last 3 on the list. And if we're assessing the top 10 on this list holistically, there's definitely some potential here. There's obviously a strong link to the real estate industry. So whether or not we think that the real estate industry is going to come roaring back if interest rates start coming down, then I think that this type of investment could actually play out. I also think that any investment that has a price to book ratio as low as Melcor Developments is definitely at least worth looking into. As for the shoe sellers, that one I'm less sure about, but then again, who knows? Warren Buffett has made some great investments in apparel companies, and those have worked out really well for him, obviously, over the last few decades. So it doesn't even really matter what the industry is. If a company is undervalued, that is all that matters. Now, before I leave you, I want to show you this because I think it's pretty cool. This stock screener tool also shows the historical performance of all of the companies that ended up in my list here. And I can see how these companies would have performed relative to the S&P 500 index over the last 5 years. And as you can see, the answer is they would have done very, very well. Now, obviously, past performance is no guarantee of future results. And really what's important is to dig into these metrics here, see whether or not a company is actually undervalued, although anything with a price to book ratio this low is something worth considering very closely. So yeah, hopefully you found this video helpful. I think it will be interesting to see how these companies perform going into 2024 and whether or not these criteria actually work yet again, because obviously the last time I conducted this search, if I had purchased all of those stocks at that time, it would have worked out pretty well. Thanks so much for watching, and if you enjoyed this video, you might also like this one right here. See you later.